Hi there, welcome to kneppyinvests. On occasion, a company on the ASX will have a really bad day. Share price of that company can fall 50% or even more on bad news. Now, just because this is a bad situation for the company and its shareholders, it can lead to an opportunity for not only non-shareholders to buy into a possible quality company at much better valuations, but also for current shareholders to add to their position of the company. Now, in my opinion, it's all about the type of announcement the company releases that leads to the really bad day. And I have taken this opportunity to buy into some companies in the past, and I've used this strategy to great effect. So I have bought into a few companies. Macmillan Shakespeare is a great example. About 10 years ago, share price of that company fell by a significant amount. I'm thinking something like 40% in one day because of proposed legislation by the Labor government, which never came to fruition. And then the share price of that company recovered really well. So I do believe it's the type of announcement that is really important when it comes to these opportunities. One of the types of announcements I more than likely will not buy into when the share price really suffers is a profit downgrade, because profit downgrades tends to come in threes, or for A to milk, it came in fours or fives. So you don't want to really take advantage of that first profit downgrade. Just wait to see if any more profit downgrades come in the future. So on the 2nd of August, we had 4 companies that had a really bad day. But the question is this an opportunity to buy into these companies at much better valuations? First company I'm going to be looking at is Appen. This is a company I've actually held in the past, and it was a market darling for a long period of time. We'll be able to see the share price increase when this company was a market darling, a favorite among tech companies and tech investors on the ASX. But share price has been falling consistently over the past 2 years, and the company keeps releasing some bad outlooks, some bad financial news. And the update, first half financial year 22 results and financial year 22 outlook announcement they did release on the 2nd of August was another negative announcement, and the share price fell 27.3% on the day. So is this an opportunity to buy into this company at much better valuations? Now, at this point in time, I would not classify Appen as a high quality company, even a medium quality company. In fact, I would consider Appen to be a fairly low quality company right now in terms of what's happening with their business. And when you look at the commentary, it's not really good reading at all. So in regards to the first half financial year 22 results, all the numbers are down. So this company is not growing anymore in regards to their profit, revenue, and all that stuff. In fact, the profit down pretty big. But it's the outlook which has me a little bit nervous about this company. So no bullishness at all in regards to the outlook for financial year 22. In fact, it's quite bearish. However, with no improvement in July trading, there remains uncertainty about a continued slowdown of spending from our global customers and their exposure to weaker digital advertising demand. As a result, the conversion of forward orders to sales is less certain this year compared to prior years. And that is telling me there is big potential for further downgrades in the future, particularly because they also mention their financial results are going to be skewed to the second half. And I never like to see that. When management are hopeful of better performance in the second half, and when their financial results are skewed to the second half after a weak first half, that is never a good look. And a lot of times you will see the company underperform to the expectations. So at this point in time, I don't think this is an opportunity to buy into Appen at better valuations, just because I think there could be further downside in the future. So I'm going to leave Appen on my watch list. I do have a small position in this company, maintaining a position. So I didn't completely sell out. And as soon as I see a little bit of a turnaround in the management sentiment, as soon as I see a little bit of turnaround in the share price and share price sentiment, I'll just hold off and wait to see if there's any further downside in regards to the company's results, financial results, and also the company's share price. Now onto the charts for Appen, and the first chart we're looking at here is the daily chart. So is there any opportunity just on a technical basis? And of course, the answer to this is absolutely no, just looking at the daily chart over the past year, because the share price is in a well-defined downtrend, And to be fair with you, anytime you do see a bit of a pop up in the share price, like we saw when there was that takeover bid back in late May, that's the time to sell. The other time to sell is whenever the share price gets above that 100-day moving average, which happened on that takeover bid day, also happened back in November last year. You can see a potential rally in the share price, but that rally in the share price failed. And we have seen a couple of times when the share price has taken a big hit. We saw this on the release of this announcement. We also saw it in the release of their full-year results back in February. Share price fell from about $8.50 all the way down to $6. So that would have been fairly negative results, and the share price just keeps on falling. So no end in sight right now to Appen's share price. There probably would be bottom pickers right now looking or deciding whether there's good value with Appen at these current prices. But those investors probably thought there was good value when the share price was $8 or $9, $10, $12, or $14, because at one point in time, the share price of Appen was $44, and now it's just above $4. Now onto the weekly chart for Appen, and this goes back all the way to the start of 2017. And this company did experience a lot of tailwinds between 2016 or 2015 all the way through to 2020. You can see share price just appreciated substantially during that period. In fact, it went from about $2 all the way to a high of $44 in August or September 2020. And fortunately, I was a shareholder during that period. I did take advantage of this share price appreciation. But ever since that high we saw back in August 2020, share price has been dropping, and share price has dropped from $44 to $4. So the share price has dropped by more than 90% in 2 years. So you might be thinking this could be an opportunity, particularly if the company can start growing again. This might be an opportunity, but at this point in time, there's no indication that the lack of growth in this company or the company can start growing again. There's no indication that's going to be happening anytime soon. And one of my problems with Appen and its management team is the lack of agility. So there's a lot of tailwinds we saw between 2015 and 2020, and those tailwinds have turned to headwinds. And I wanted to see how the management reacted to that lack of tailwinds. And really, to be honest with you, they have not shown me anything in regards to being agile, in regards to being flexible in how they are running this company and how they are viewing this company in the future. So that's one of my biggest problems with Appen right now is the management team. Now to LiveTiles, and LiveTiles I've been following over the past few years because the share price, just like Appen, has been dropping at a consistent rate. And to be honest with you, the financial performance of this company has been underwhelming and really disappointing. At one point in time, this company was growing their revenue, annual recurring revenue, at a really quick rate, and it's just stopped on a stone. It's no longer really growing at a fairly significant rate, and we've seen the share price decrease and drop like a rock. And on the 2nd of August, the company announced they are voluntarily delisting from the ASX. And no wonder the share price dropped by 1.50%, but it finished the day at 3.8 cents, which was a drop of 36%. Even though they do include reasons why they are delisting, it still doesn't make sense to me. One of the reasons they have included why they're delisting is around the company valuation. And I'll just quote you this, and it just tells me that the management really overrates what they are doing and overrates themselves. The board considers that the trading price of the company shares in recent years implies a valuation that has been and remains consistently and materially lower than the valuations of unlisted companies of a comparable nature and stage to LiveTiles. So they are comparing themselves to other companies. But this company is not cash flow positive, not free cash flow positive, not profitable. They're not even growing their revenue. Or if they are growing their revenue, it's a very slow pace. So again, they're completely overrating this company and themselves by thinking the company is undervalued. The best way to put this is the ASX is valuing the company absolutely right now because the ASX wants to see this company has a path to profitability. And right now, there is no path to profitability for this company. And that's why the share price has absolutely fallen like a rock over the past 2 years. And again, the company released Appendix 4C, the quarterly report, and it completely underwhelmed, and the share price fell significantly on the back of that Appendix 4C. So I think one of the problems here is management completely overrates themselves. Some of the other reasons they gave for voluntary delisting includes capital raising. So they're saying, oh, we don't need a capital raise, but if we do want a capital raise in the future, well, again, they're going to have to capital raise because they are bleeding money, and they continue to bleed money. They've been bleeding money for the last 3 or 4 years, or ever since they listed on the ASX. So they mentioned here, if the company seeks to raise further growth capital in the future whilst listed on the ASX, this would likely impose a high dilutionary cost on non-participating shareholders than if the company was more fairly valued. Again, it's fairly valued right now. You're just not performing as a company, as a management team. And then you talk about dilutionary. If you do a capital raising, the share price dropped 36% on the back of this news. So you've just screwed over your shareholders by this one announcement. Strategic and corporate opportunities. Employees, they mentioned here they can't attract good employees because the share price is down. The valuation of this company is down. They actually mentioned there's a disconnect between the company's share price and its fair value. Why do you think the company is not fairly valued right now? It's absolutely ridiculous. You're not profitable. You're not operating cash flow positive. You're not free cash flow positive. Your fair value right now is zero because you're not profitable and you have no path to profitability. Some other reasons they give here also include illiquidity, product strategy, and cost. So an absolutely ridiculous decision by LiveTiles. I've seen some chatter that other companies have done this. Updata did this a few years ago, 2018, and they're valued now at $2 billion. But you can't compare Updata to LiveTiles. It's a completely different situation. And the market right now is completely different than it was back in 2018. And no wonder the share price dropped 36%. This is not an opportunity to buy into LiveTiles. I don't see any future for this company moving forward. This company's not growing right now. It's not growing. So there's no path to profitability. This is not an opportunity, in my opinion. And all you have to do is just look at the charts for LiveTiles. This is a daily chart for the company. And we have seen at times, particularly in March of this year, when the share price looked like it was going to rally. But when the company did, and just before the release of their Appendix 4C for the June quarter, share price was rallying. And as soon as they released that Appendix 4C, that possible shift in sentiment totally changed from shifting to positive to back to negative. Share price actually fell from, was about 8.5 cents down to 6 cents on the back of that Appendix 4C. So again, it's the financial performance of the company. A lot of negative sentiment in regards to this company, in regards to the management. And I think this was the worst decision the company can make. The best thing they can do is have a path to profitability, decrease costs. I don't know what they can do, but that's what they are being paid for. That's what management is being paid for, a path to profitability. Show the market that you have a plan. And as we turn our attention to LiveTiles weekly chart, going back to when they listed on the ASX way back in 2016, at times there has been hype in this company. So at times there was this perception, and particularly back towards 2017, 2018, when there was really good growth in this company's revenue and recurring revenue. And that's why the share price went to a high of 76 cents at one point. But this company at that point in time was bleeding cash like nothing else. So they were spending a lot of money to get that revenue and recurring revenue to increase. But ever since that high share price of 76 cents back in 2018, share price has been dropping because the company has been underperforming. Management have been underperforming. They have no plan to profitability again. So I've mentioned that plan of profitability. It's really important because the way you value any company is you get the present value of all future cash flows. At this point in time, the present value of all future cash flows for LiveTiles is absolutely zero because they have no plan to profitability. Now onto Wiseway, and Wiseway is a fairly low quality company. Now, it is a low quality company, and that's reflected in the market, the valuation of the company. I think the valuation right now is less than $20 million. Now, the company does have fairly high revenue, so above $100 million, if I remember correctly. This is a delivery sort of company, but the company also has really low margins. So whenever something impacts their margins, and that they have many sort of factors can impact their margins. For instance, flooding in New South Wales and Queensland, lockdown measures in China, and inflationary pressures have an impact on their margins. You will see that have a significant impact on their profit, and that's why the share price dropped 24% and the share price finished 9.5 cents. So this was a profit downgrade. And because of all those factors I mentioned, flooding, lockdown measures in China, inflation pressures, the company anticipates EBITDA will be within a range of 2 to 3 million and earnings before tax to be a loss of between 4 and 5 million. So there's no wonder why the share price dropped 24%. However, in saying that, in the outlook, the company was a little bit more, say, bullish than compared to Appen's outlook. So they mention here the company remains positive in its outlook given the diversified nature of its global network of interconnected business divisions, its long-term and loyal client base, and its strong operating platform. So possibly this decrease in share price, and we'll have a look at the chart because where we see the share price right now compared to historical levels, it is interesting. So this could be an opportunity to buy into this low-quality company if we see some good financial performance from this company over the next few years. And this is the daily chart for Wiseway. They listed on the ASX a few years ago, and the share price went to a low of about 9.5 cents back in June, July of 2020. So just after the COVID-19 financial panic, share price reached a low, but the share price recovered quite well. In fact, the share price quadrupled from its low back in July of 2020 to its high back in August 2021. So over a 1 year period, the share price quadrupled. So you can make some money off these sort of companies, these low quality companies, because of a shift in sentiment. And then that shift in sentiment turned around from positive to negative back towards the end of 2021. The share price has been dropping at a consistent rate. So share price has dropped from 44 cents all the way back to those levels we saw in July 2020 at around about 9 to 9.5 cents. So potentially this is a good time to buy this company. However, I would probably rate this company as a high risk, potential high reward. Now, if they can start, if that bullishness can come to fruition and we will see a company return to profitability, starts to see increasing revenue, increasing business, then there is that possibility the share price will quadruple from here. Just a possibility. So high risk, high reward sort of company, a potential opportunity, not for me just because it's a really low quality company at this point in time. Now, to the best quality company in this group, and that's Credit Corp. They released their financial year 22 results on the 2nd of August. And I did get an alert because the share price was down about 10% at one point in time. And I thought, oh, this is interesting because the market more than likely is overreacting. I did not read the results. I have not yet read the results. So more than likely, either the results disappointed the market, so results were less than expected, or any sort of outlook from the company was disappointing. Now, in saying that, I got that alert. The share price was down big on these results, and I thought this might be a good opportunity. And that's exactly what the market thought, because the low on the share price on the 2nd of August was $20.31, yet the share price finished at $23.02. So a lot of buying came in during the day because the market saw a really good opportunity to buy this high. I'm not sure if I call Credit Corp a high quality company, but it's heading towards that area. So a potential high quality company at really good or better valuations. And that's why the share price increased during the day. So even though the share price was down 5% from the previous day, there was a lot of buying coming in, and the share price was significantly higher than low for the day. Now, as we take a look at Credit Corp's chart, this is the day chart going back almost 1 year, and the share price was moving up. From July last year to January of this year, share price reached a high of $36. But then that positive sentiment shifted to negative, and the share price started to fall, and then the share price fell, almost halved from $36 to $18.50, and that low was in June. And that was a really good time to buy. We saw on the low, at $18.50 day, there was pretty good volume came in on day. So that was a little bit of a sign that there were some participants in the market who saw some value in Credit Corp at $18.50. And then the share price has rebounded. In fact, the share price rose from $18.50 at that low to $24.50 the day before the company released these financial results. Now, the really interesting thing is the trading on the day. So really high volume, abnormally high volume when you compare the volume to the rest of the year. So over 1.6 million shares traded, and historically over the past year, the maximum amount of shares traded in one day is around 800,000. So double the amount of shares traded on this day. The other interesting fact is the low of the day and the opening of shares trading on the day were really low. So the shares opened at about $21 and the low was just under $20.50. But again, a lot of buying came in, which propped up the share price during the day. And that's why the share price finished near the high of the day, around $23. So a really interesting reaction from the market. Now, I think the best opportunity to buy this company would be below $20, which we saw towards the end of June, start of July. That's why we saw a little bit of buying during those times. I'm not the biggest fan of Credit Corp, even though I would call it almost a high quality company. I'm not the biggest fan of what this company does, but for those interested, I think this could be an opportunity, particularly if we see further downside over the next few weeks towards $20. This could be an opportunity to buy into this company at better valuations. And one of the reasons I say that is when you look at the weekly chart going back to 2014, share price generally is going up. So if you take away the massive decreases in the share price during the COVID-19 financial panic, share price dropped from $38 all the way down to $6. So the market was expecting this company to be severely affected by COVID-19, the after effects, but then share price rallied. And whenever you see a significant dip in the share price, that's the time to buy this company, because generally over the past 8 years, the share price is in an uptrend. So again, that's why I was mentioning any time the share price gets below $20 might be a good time to buy this company, if you like the company, that is. That's all I have for this video of looking at 4 companies that had a really bad day, or maybe not a really bad day for Credit Corp, but a bad day on the 2nd of August. So that raises a question: is this an opportunity to buy into these companies at better valuations? I think the best quality company by far on this list was Credit Corp. It's not my favorite company simply because what they do, but I think there is a potential opportunity, potentially, particularly if the share price drops below $20. So look out for that if you like Credit Corp. And the other companies in this have their problems. So Appen, I think that company is experiencing some significant headwinds right now, and I need to see those headwinds coming to an end and some tailwinds coming back into business before I add to my position in that company. LiveTiles, absolutely no, particularly if they are delisting, and the shareholders have a say there. So the shareholders can say no in regards to that delisting. I think that would be very negative for shareholders. And that's why the share price dropped 36%, because people don't want to be owning a company they can't sell easily on the ASX. Wiseway Group is interesting in regards to a low quality company that is looking attractive based off valuation and historical levels. So maybe position that company at less than 10 cents if you don't mind taking a bit of a risk, but there could be a high reward for that company. If you have any questions in regards to any company I've mentioned in this video today, any thoughts, any opinions, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.